Hello and welcome to The Enterprising Investor, the flagship investment podcast for CFA Institute. I'm Mike Wallberg, and I'm joined today by Clare Flynn Levy, founder and CEO of Essentia Analytics, a firm that provides behavioral analytics services to professional investors and capital allocators. At the core of Essentia's offering is something they calculate called an investor's behavioral alpha score, which analyzes elements of an investor's process and quantifies their decision-making skill. In a recent white paper, Clare and her colleagues set out to test whether investment decision-making skill was predictive of outperformance. And we're going to find out today. Welcome to the show, Clare.
Thanks for having me.
So to start us off, maybe describe what a behavioral alpha score is.
Sure. Well, I suppose it helps to start off by explaining where it's coming from. So the background here is that I was once an active equity fund manager myself. And I wanted to continuously improve as a fund manager and continuously make better decisions if possible. And so set out to try to analyze my own decision making. And through that journey that unfolded over the next decade, we arrived at what we call the behavioral alpha score. It is a measure of decision making skill. We call it behavioral alpha because, in this day and age, alpha is very hard to come by, harder than ever. You can't find it by being smarter than other people, really. I mean, not in a sustainable way. You can't generate sustainable alpha through having better information than other people. That's for sure. So what can you do? Well, you can generate sustainable alpha by making better decisions than other people make. Because humans are biased and flawed, and we all have read about this, and we are all aware of the field of behavioral finance, but until now, there hasn't been a way of measuring decision-making skill and therefore improving it. And that is what the behavioral alpha score does.
Okay, so not to ruin the ending here, but in terms of the study that you conducted looking at the impact of these decisions, what were your high-level findings from it?
Well, so what we did in the study was take 123 unique long-only equity portfolios and use data daily holdings data from those portfolios between 2013 and 2023. So altogether, that was 532 portfolio years of data. And the question we set out to answer was, is the behavioral alpha score as a measure of decision-making skill predictive of performance? To start with, what we wanted to check was, are we sure that past performance is not predictive of performance? Because if that's the case, all bets are off. There's no need for this.
All our compliance listeners' ears are perking up right now. They're all freaking out about the footnotes.
It bears, let's just check in with that because it's important statistically. And we did that. So the answer to that, not surprisingly, was no. Past performance was not predictive of future performance. So the behavioral alpha score was predictive of future performance, but only within the same year. So if you said, is the behavioral alpha score a crystal ball that will tell you exactly who's going to perform well? Within the same year, you might call it that, but that's not really the time frame that people care about. The question is what about further out than this year?
Yeah, so there was a correlation between detected high skill in that 1 year time period and high performance that year.
Exactly. And it's
Okay.
Well, that's not surprising. That's not really telling you anything that exciting. But the exciting part came when we looked at a comparison of managers with a score over 50. So the behavioral alpha score 50 is effectively what it would have been achieved by chance. So that's the sort of baseline. What we found was that managers with scores over 50, and this is looking at the past 3 years of their decision making, and it's looking at the P&L generated by their decisions compared with the P&L generated by their benchmark. So it's all done in relative terms. And it's saying, okay, if we look at all your decisions over the last 3 years and the value they added in relative return terms, did you add value through your decision making? And a manager who has a score over 50 did. and a manager with a score under 50 did not. So what we found in the research was that managers with scores over 50 were 1.5 times as likely to outperform their own benchmark in the subsequent year as managers with score under 50. So practically speaking, while it's not a crystal ball, it is saying you could compare two managers on this basis and have a better sense of which one is more likely to outperform, which is a very valuable thing to be able to do if you're an allocator or a manager selection person.
For sure. And not to skim over the first point you made there, which is that it did have explanatory power in the first place, right? Apart from forecasting future potential outcomes. Can you talk a bit about that? Just a little bit of the detail around kind of what tests you did, the factor models that you applied to it.
Yeah, I mean, so then the question was, would this be additive to the model of somebody who is selecting managers based on, traditional Fama French factors and, the sorts of stats that we've all been learning at university all these years. And there are some large firms that have very sophisticated models at this point that are being used to predict which managers are more likely to outperform. So would this be additive to that? And what we found was yes, it would. So we looked at whether it added explanatory value in the context of the Fama French 5-factor model as well as the 3-factor model. But in both cases, the answer was yes. What it's saying, to me anyway, is that as a fund manager, part of what you're doing is picking the right stocks, right? That's half the battle is the idea. But the other half is the execution. And the stocks you pick are reflected in risk factors as defined by Fama French. But the what you did, the execution piece, is just sort of lumped together in alpha. And that's the sort of the part that everybody's trying to find and put their finger on. And what we're saying is this actually can quantify some portion of that alpha piece. So you can hone in that much better.
Can you push in a bit on what those decisions were? Because I know you have 7 that you looked at. I'm just curious if you could talk a bit about how finely you cut this when you were looking at individual decisions that make up skill.
Sure. Well, so what we did, and this is what we do, day to day at Essentia Analytics, is we take historical holdings data, daily holdings data, and we assemble that data into what we call investment episodes. So if you think about this like sports analytics, okay, an investment episode is like a game, and every game has a game tape. And we do, not in the behavioral alpha score and not in this piece of research, but separate to that, we do a lot of analysis about episodes and what do your good episodes have in common and what did your bad episodes have in common. But then what we do is break down the episode into its constituent decision types. And the sort of first principles basis of all of this is a fund manager's job is to make decisions. And if you're the fund manager, it should be a goal to make the best quality decisions that you can as often as you can. And in fact, invest as much of your energy as possible into making the decisions where you have the highest probability of making a very good decision, and invest as little energy as possible into making decisions where historically you've done a bad job. But not all decisions are created equal. So what we're doing is decomposing each episode into 7 different decision types. And at the most basic level, you've got the picking decision. Okay, that's the difference between the outcome of having held one share of the stock that you held and having held one share of the index. So very simple, but it's about isolating just that decision to hold that stock. Then you get into sizing decisions. Which, if you were not making a sizing decision, you would just hold an equally weighted portfolio. So every day that you're not holding an equally weighted portfolio, you're making sizing decisions wherever you're not holding the equal weights. So we look at those. And that's by comparing the portfolio every day with an equally weighted portfolio. Then we look at entry timing decisions. And that's about, identifying the point where the first share was bought and then looking, in this case, 1 month into the future and saying, would you have been better off just taking the average daily close over that 1 month window? Was there really any value added by this? Then we look at scaling in. So the timing of the day you bought the first stock is one thing, but then how quickly do you ramp it up and how quickly do you build that position? We call that scaling in. And again, we're looking at, well, what else could you have done? Let's just take the window over which you did your scaling in and say, what if you just set an algorithm to get you the average daily close? So it's a bit like, in each case, throwing a dart at a dartboard. What's what you did better than throwing a dart at a dartboard? And so, maybe yes and maybe no.
How do you account for liquidity constraints on that, or do you? I mean, because certainly, obviously, bigger managers are going to have to be a little bit more slow and thoughtful on scaling into decisions. Is there a way to account for that?
Yeah, you can. So, it all depends on the window that you're using, the type of strategy that you're looking at. We work in great detail with managers of all different types of equity strategy, and some of them don't scale in, they just go straight to size. Some of them take a really long time to get in. Sometimes that's driven by liquidity. Usually it's not. That's just a matter of style and how their organization behaves sometimes. It's more on the way out when you're scaling out that liquidity can rear its head and you can see that people's exit timing. So I mentioned entry timing. We also look at exit timing. I mentioned scaling in. We also look at scaling out. When you look at the scaling out and exit timing, those tend to be the skills that people struggle with the most. That's where you'll get the most portfolio managers with scores under 50. And that maps to loss aversion behavior and, all the biases that we've all read about that are to do with what happens when things are going down or when you're losing money. So it's all very familiar. But if you were running a small cap strategy or an emerging market strategy or something, where the liquidity is tight, you might say, oh, I have a poor exit timing and scaling out score. That's because of the liquidity, it must be. Maybe. That's a hypothesis. So what we'll say is, it doesn't matter to me either way. So let's have a look. Let's see. If it is, then you can quantify the cost of the strategy in that sense, or if this is about the fact that your fund is so big, you can't move in and out with ease, it's telling you something about the cost of letting the fund get that big. But actually, you'd be surprised. Sometimes people think liquidity is what's causing it. And actually, when you look at the analysis by the percentage of average daily volume that you're holding in the stock. So if you divided up all of your episodes by what was the max average daily volume that we held in that stock over its life, and then said, all right, are the ones where we did poor exits the ones where we were the most illiquid? It's usually not the case.
Yeah, people fall in love with their stocks, right? Or they don't want to admit an error. I mean, like you say, it's a classic behavioral error, right?
And sometimes it's about, I don't want to upset the analyst. I don't want to undermine this person. There will be institutional reasons that people, take longer over these decisions than they otherwise would. And you can show that back to them, and then you can help them come up with ways of making that decision more efficiently without it being so personal. It's just a matter of when the stock behaves like this, here are the rules that we implement. We ask ourselves this question, we ask ourselves that question, and then based on the answers to these questions, we either buy it or we sell it. And that helps a lot. And then you can measure, whether the exit timing and scaling out are improving, which is always very gratifying.
So within those 7 decisions, then, effectively, it sounds like each one, you have some kind of a test that determines whether it was a good or a bad decision. So you've got, but did the stock beat the market? Did your position, and if it beat the market, these are the classic attributions things you look at, right? If it beat the market and you own more than index, then that was a good decision. How do you weight those decisions in the actual calculation of the score? Are they all equally weighted in terms of like adding up to what kind of score you get, or is stock picking more important? Is overall weighting more important, or like how does that work?
We talked about it a lot because different people have different views, and instinctively you might say, well, picking should be the most important one, or maybe picking and sizing. But actually, we don't weight them. So they each have an equal weight, and it's on the basis that if you're making, if you're a very low turnover manager and most of the decisions you're making are picking decisions, and then every day you hold the stock, you're repicking it effectively. But that's kind of all you're doing. You don't have a lot of entries. You don't have a lot of exits. The seventh one, if anybody was counting, that I didn't mention was size adjusting, and that's about adding and trimming. But, say you don't do much of that, then, out of the N number of decisions, more of them are going to be picking decisions, proportionately than would be the case for somebody who's doing a lot of adding and trimming. But then you would say, well, the person who's doing a lot of adding and trimming, ultimately, this is about is this person adding value or destroying value? If you want to look at, did they pick the right stocks? There are lots of analytics you can do specifically about that. But is all the energy that they're expending and maybe fees that they're paying on transaction costs and all the rest, is that actually adding value? And if the answer is yes, great. That's everyone's a winner, and that's all we need to know. If the answer is no, then that's a conversation that needs to be had.
So if I understand it correctly, the scope of the paper defined an episode as 1 year. So you're looking at kind of what happened in terms of the decisions that the PM made in that year around, the holdings in their portfolio. But as you know, often these theses play out over 3 or 4 years. So any given year may be certain theses bearing fruit, certain theses burning out, certain stocks being added as new ideas. So is there an appetite to tackle a longer term study to test the value added over a longer period, or how do you think about that?
Well, it's actually in the study, it's looking at 3 years overall. So you're taking data for 3 years.
Okay, so I misunderstood. Okay.
But it's a fair point, because going into the future, all it's saying is we can tell you which manager is more likely to outperform next year. And if you're an allocator and you say, well, I'm choosing managers for, the long term, where does that leave me? Fair enough. It's a good point. That's for us to explore with the next research. But in the meantime, I would say to that manager, well, yeah, you invest for the long term, but every year you need to re-underwrite that investment and revisit, do I think this guy's or this woman is going to keep outperforming for me next year, as well as, 5 years down the road? And is there any reason to believe that story is deteriorating, or that, their ability to outperform for me has changed? And this is what this data can tell you. It'll either give you reassurance, pause.
That's actually one thing that I wanted to talk to you about, and that's this idea of its applications for fund selection. Because as you know, it's all too common, unfortunately, especially among retail investors, to pick last year's winners. And even in an institutional setting, you have the benefit of consultants who vet managers based on things like culture, adherence to style, persistence of performance, stability of the team, ownership structure, and on and on. It seems to me that for the layman or even the professional, being able to quantify manager skill would be hugely helpful. How do you see this metric being applied across market segments?
So amongst the allocator community, it is still early days for this. So we have been working with allocators for a few years now, but that has been exclusively those who have segregated accounts and therefore have access to the daily holdings data of the underlying managers, and so can do this sort of analysis. And they use that in manager selection as part of their due diligence process. These would be, more institutional investors. And then also as an ongoing part of how they monitor those managers, they sit down with the manager quarterly and they bring an Essentia report with them, and they, ask questions or share thoughts based on what's in that report. But what's happening increasingly, our goal with this is to make it mainstream and to make the behavioral alpha score something that everybody looks at, just like you look at past performance, which is not predictive, as we've established. But, you haven't necessarily had anything else to look at. And, you can do qualitative research and try and gauge all those things that you listed about the team and the process and all that kind of stuff. But there's not been anything better to go on quantitatively. And now that there is, it means that even if you don't have access to daily holdings data, if you're invested in pooled vehicles, you will soon be able to see a behavioral alpha score for any manager based on their monthly holdings data. And that's through a partnership that I'm not quite yet at liberty to announce, but it's coming soon. And I guess the message to managers in that is this is happening whether you like it or not. This data the world of data is moving very quickly, and the data is already out there. So,
especially with ETFs publishing, the rise of active ETFs publishing their holdings daily, right? That's a different world than we lived in 20 or 40 years ago.
I mean, that makes it way easier because then we already have data on, I think, over 200 ETFs in our behavioral alpha benchmark, and that's just public data. So, if you're the manager, you need to be able to explain yourself one way or the other and brag about yourself if your score is really good. If it's not, at least understand it and be able to speak to it, because allocators aren't necessarily going to make a decision to fire you based on your behavioral alpha score, I hope. I'd like to think they would give you a chance.
Or hire you.
Yeah, but I'd like to think that if they're thinking about hiring you, that they'll use this as an extra substantiation of their thesis, and it should validate some of the stuff they found in their more qualitative research about the firm and the process. But if your score's not good and you're looking to retain assets, which, a lot of managers are, then it's about it being able to explain yourself and explain that you understand, because you now have this level of visibility, you understand what you can do better to get, or do differently to get a better result. And now you're going to. And allocators do cut you slack if you have a plan, just like anybody in life. It cuts you slack if you have a plan. Now you've got to follow through with the plan, but it's everybody benefits in the end from being able to see this data. It's just the manager needs to sort of wrap their head around the fact that, it's a different level of transparency than existed before. That's the way of the world.
So unfortunately, we're coming to the end of our chat today, Claire. I'm going to hit you with the two-parter to wrap up the interview here. And what was your first job in the industry? And if you could go back and take yourself for coffee on your first day, what key piece of advice would you offer yourself?
Well, my first job in the industry, this sounds like a cliche, but I swear to you it's true, was in the mailroom at Gabelli Funds, which is a mutual fund company in the U.S., and I was stuffing paper prospectuses in envelopes because, this was a long time ago. I'm not going to betray my age here, but a long time ago. And it was literally stuffing little brochures into envelopes and sending them out to people from a fund management company. But from there, worked my way into answering the phone, and from there into data entry, and from there into the front office. And the rest is history. But what would I have told myself when I first started out? I think I wish I had kept better records. I think, and I would give this advice to any person starting out in the industry. When I was doing PA investing, because that's all I was doing when I was working in the mailroom, I didn't, I did start investing for myself, but in a very small way. I wish I had captured more data about what I was thinking and doing, and whether that's keeping a trading journal or, better yet, doing it in a structured data format that you can then analyze, and not letting that data go. When people, if you're going to change firm or you're going to move to a different role, see if you can negotiate taking that data with you, because it is valuable. And down the road, it would be useful to be able to look back, or amusing, if nothing else. So I wish I had done that.
I've been speaking today with Clare Flynn Levy, founder and CEO of Essentia Analytics and co-author of Actions Speak Louder Than Past Performance, the relationship between professional investors' decision-making skill and portfolio returns. That can be found on Essentia's website, and for the academics in the crowd, it's on SSRN. Thanks so much for coming on the show today, Clare.
Thanks for having me.
I'm Mike Wallberg, and this is me, the Enterprising Investor.